Take a look at your crypto portfolio. Does it feel lost? Just a random collection of coins with no clear strategy? All you probably hear are wild, confusing predictions about 2026. Some say Bitcoin is headed for a brutal correction, maybe back down to $60,000. Others are calling for a moonshot to $250,000 or even $300,000. It's chaos. You're not alone in feeling this way. In fact, most people who jump into crypto end up with a messy, disorganized portfolio that feels more like a lottery ticket than a real investment. But what if I told you that you could clean up this chaos? What if you could build a solid, future-proof portfolio in just 90 days? A portfolio that doesn't rely on you guessing the market's next move, but is built on a foundation of strategy and discipline. In this video, I'm going to give you a simple 3-step plan to do exactly that. We're going to cut through the noise, ditch the dead weight, and build a portfolio designed to thrive, no matter what 2026 throws at us. Let's get started. The biggest problem in crypto isn't volatility, it's having no plan. Most portfolios turn into a graveyard of forgotten tokens, bought on a whim during some hype cycle. That one coin that was supposed to be the next big thing is now down 90%. Another one you bought because of a tweet is just sitting there, doing nothing. That isn't investing, it's gambling. And it's incredibly stressful. You're constantly checking prices, worried about missing the next pump, and terrified of the next dump. This 90-day plan is your way out of that cycle. It's not about finding the next 100x gem. It's about building a system that takes the emotion out of investing, lowers your risk, and positions you to capture the real long-term growth in this space. By the end of this, you will have transformed your chaotic collection of coins into a portfolio that makes sense. You'll know exactly what you own, why you own it, and how it fits into your goals for 2026 and beyond. This is how you stop being a passenger in the crypto market and start being the driver. The first 30 days are all about assessment and cleanup. You can't build a strong house on a rotten foundation. And you can't build a strong portfolio on a pile of underperforming, narrative-dead coins. This is the real talk part of the process. It's time to be honest with yourself about the mistakes you've made and to get rid of the assets that are holding you back. Our first task is simple but critical. Document everything. Open a spreadsheet or use a portfolio tracker and list every single crypto you own. For each one, write down the name of the coin, how much of it you own, the current market value of your holdings, the percentage that this one coin makes up of your entire crypto portfolio. That last part is where the red flags will start popping up. This is how you find your concentration risk. Did that one lucky trade from last year balloon into 40% or even 50% of your portfolio? That's not a sign of genius, it's a sign of extreme risk. A single downturn in that one asset could wipe out half of your crypto wealth. As a general rule, any single token that's more than 20 to 30% of your holdings is a sign of unhealthy concentration that needs to be fixed. This is one of the most common ways new investors get wrecked. They let their winners run without a plan, and then they ride them all the way back down. Next, it's time to evaluate the quality of what you own. For every single coin on your list, you need to ask some hard questions. Is the development team still active? Go to their GitHub, check their social media, read their recent blog posts. Is there any sign of life? Or has it been radio silence for 6 months? Projects with inactive development are dead weight. And what about the narrative? Was this coin part of a trend that has since died? For example, if you're still holding on to a metaverse coin from 2021 that has no users and no recent updates, you have to ask if that capital could be better used somewhere else. Be ruthless here. This is like cleaning out a cluttered drawer. You have to get rid of the junk to make space for what actually matters. Selling a coin at an 80% loss is painful, I get it, but it's far better than watching it go to zero while better opportunities pass you by. This clearing the drawer step is essential. It stops dead weight from dragging down your performance and frees up capital for the next phase. Now that you've cleared out the clutter, it's time to design your ideal portfolio. This is your blueprint. First, think about how much of your total net worth should even be in crypto. For most beginners, keeping your crypto allocation between 1 to 6% of your overall investment portfolio is a sensible range. Some studies even show that a modest 5% allocation to a diversified crypto basket can actually improve the risk-adjusted returns of a traditional portfolio, even during downturns. With that number in mind, let's structure your crypto holdings. We're going to use a simple, proven model. Think of it as a pyramid. The base of the pyramid, core holdings, 50 to 60% of your crypto portfolio. This is your foundation. This is the part of your portfolio designed for stability, your low-risk anchor. For the vast majority of people, this should be one asset, Bitcoin. Why? Because Bitcoin is the most established, decentralized, and institutionally recognized asset in the space. It's seen as digital gold, a hedge against inflation, and the bedrock of the industry. By making it half of your portfolio, you're anchoring your wealth to the most secure network in crypto. You could also include stablecoins here, especially if you want to have dry powder ready to deploy during market dips. The middle of the pyramid, sector bets, 30 to 40%. This is where you diversify for growth. But we're not just randomly buying altcoins. We're going to strategically invest in key sectors that look ready for major growth heading into 2026. You should pick 3 to 4 sectors you truly believe in and allocate capital to the leaders within them. Based on current trends, the most promising sectors for 2026 include Layer 2 scaling solutions. As Ethereum keeps growing, the demand for faster, cheaper transactions is exploding. Layer 2s are the main solution. Look for platforms with real user growth and thriving ecosystems. Web3 and decentralized infrastructure. These are the protocols building the backbone of the next-gen internet. Think decentralized storage, computing, and identity. Artificial intelligence, AI-linked tokens. The intersection of AI and blockchain is just getting started. Projects focused on decentralized AI have massive potential as the global AI sector booms. Real-world asset, RWA tokenization. This is the trend that many believe will bring trillions of dollars of value on-chain. It's all about representing physical assets like real estate or private credit as tokens on a blockchain, which unlocks liquidity and access. Low-cost payment networks and stablecoins. As crypto gets more integrated into daily life, networks that can handle cheap, instant payments will be critical. The adoption of stablecoins, especially in emerging markets, is a powerful and growing trend. The key here is to not over-diversify. Owning 25 different tokens you can't keep track of is a recipe for disaster. It creates hidden risks and makes it impossible to monitor your investments properly. Choose 3 to 4 sectors, do your research, and pick 1 or 2 of the strongest projects in each. The tip of the pyramid. Experimental allocation, 5 to 10%. This is your degen bag, but a controlled one. This is where you can take a small shot on newer, high-risk, high-reward projects. Maybe it's a new gaming token, a SocialFi app, or a project in a totally new category. The critical rule is to keep this allocation tiny. If these bets go to zero, it won't sink your portfolio. If one of them hits a 20x return, it provides a very nice boost. This disciplined approach lets you play in the more speculative side of crypto without taking on catastrophic risk. All right, welcome to month 2. You've done the hard work of cleaning out your portfolio and designing your target. Now it's time to execute. This month is all about disciplined action, taking profits, reallocating capital, and moving your portfolio from its current messy state to your ideal structured blueprint. Step 3, systematic rebalancing, weeks 5 through 8. Rebalancing is simply the process of getting your portfolio back to its target weights. It's a simple concept, but it's where most people fail because it forces you to do the opposite of what your emotions are telling you. You have to sell what's doing well and buy what's lagging. Let's make this real with an example. Imagine after your audit, you found your portfolio was 70% Bitcoin because of a recent price surge, and 30% was a random mix of alts. Your new target is 50% Bitcoin, 40% in your chosen sectors, let's say L2s and AI, and 10% in an experimental bet. The rebalancing process is straightforward. Take profits strategically. You will sell off 20% of your Bitcoin holdings. Yes, you are selling your winner. This is the hardest part for most people. It feels completely wrong to sell an asset that's on a tear. But this is the core of risk management. You are trimming an overweight position to lock in gains and lower your concentration risk. Reallocate systematically. You now have that cash, plus the cash you freed up from selling your dead weight coins in month 1 ready to go. You'll systematically move this capital into the underweight parts of your portfolio. You'll buy assets in the L2 and AI sectors until they make up 40% of your portfolio. And you'll put a small piece into your experimental bet until it hits that 10% mark. This disciplined process short circuits emotional decision making. You're not chasing the latest hot narrative. You're methodically building the structure you already designed. A note on dollar cost averaging, DCA. But what if you're worried about a market correction? What if those analysts predicting a drop to $60,000 Bitcoin are right? This is where dollar cost averaging, DCA, is your best friend. By the way, if you're finding this step-by-step guide valuable, do me a favor and hit that subscribe button. The crypto market changes fast, and my goal is to keep you ahead of the curve with clear, actionable strategies just like this one. Your support really helps the channel, and it ensures you won't miss critical updates for 2026. We're in the home stretch. In month 3, we shift our focus from offense to defense. You've built your new optimized portfolio. Now you need to set up the rules and systems that will protect it and keep it aligned with your goals for the long haul. This is how you make sure your hard work doesn't unravel the next time the market gets choppy. Step 4, managing downside risk and setting rules. Weeks 9 through 12. The crypto market is cyclical. Corrections are natural and healthy. Having a plan for these moments is what separates successful investors from those who panic sell at the bottom. Establish rebalancing triggers. Your 90-day fix is just the start. For ongoing portfolio health, you need a maintenance plan. For most people, a quarterly check-in is enough. At the end of every quarter, review your portfolio. But you should also set percentage-based triggers to prevent things from getting too out of whack between check-ins. A good rule of thumb is to rebalance if any single asset or sector drifts more than 10 to 15% away from its target. For example, if your Bitcoin allocation grows from its 50% target to 65%, that's your trigger to rebalance it back to 50%, even if it's before your next quarterly review. This stops concentration risk from slowly creeping back in. Audit for hidden risks. Take one last look at your new portfolio. Are there any hidden connections? For example, do you own 2 different layer 2 projects that are built on the same underlying tech? While they seem like separate bets, a technical problem with that core technology could hit both of them at the same time. True diversification means investing across different sectors and, ideally, different tech within those sectors. Integrate with your broader financial life. Remember, your crypto portfolio doesn't exist in a vacuum. It's just one piece of your overall financial picture. Some of the most robust long-term portfolios combine crypto's high growth potential with traditional hedges like gold and inflation-protected bonds. This creates a more balanced, all-weather approach to building wealth. And finally, prioritize using regulated and secure platforms. As big institutions get more involved, using spot ETFs and reputable, regulated exchanges is more important than ever for reducing custody and compliance risks. And there you have it. A 90-day plan to take your crypto portfolio from chaos to clarity. Think about the journey. In month 1, you did that brutally honest audit, clearing out the junk and spotting your biggest risks. Then you designed your ideal 2026 portfolio, built on that solid pyramid structure, a 50 to 60% core in Bitcoin, 30 to 40% in high growth sectors like AI and RWAs, and a small 5 to 10% for your experimental bets. In month 2, you executed. You systematically took profits and reallocated that capital into your target sectors, using dollar cost averaging to sleep better at night. And in month 3, you built your defenses. You set up a long-term maintenance plan with quarterly check-ins and rebalancing triggers to keep your portfolio on track. The beauty of this plan is its simplicity. It's not about predicting the future. It's about preparing for it. Whether Bitcoin is at $60,000 or $160,000 in 2026, you'll have a portfolio that is structurally sound, diversified across key growth areas, and managed with discipline, not emotion. You've taken back control. This whole process is about building resilience. The crypto market will always be volatile, filled with hype and fear. But with this structured approach, you no longer have to be a victim of that volatility. You have a system. Now, I want to hear from you. What's the biggest challenge you're facing with your portfolio right now? Is it too much concentration? Too many random coins? Let me know in the comments below. Sharing our experiences is one of the best ways we can all learn and grow as investors. Thanks for watching, and I'll see you in the next video.